There is a document sitting in your email inbox right now, or buried in a folder you have not opened since the year you first got a bank account, and inside that document is a sentence that your bank has never once asked you to read, never highlighted, never summarized, and has no legal obligation to explain to you before using it against you. And the moment that sentence becomes relevant to your life is not a moment you will see coming. I am going to show you exactly what that sentence says, but I need you to stay with me until the end of this video, because the thing I am building toward, the clause I am saving for last, is not the most alarming thing in this video on its own. It only lands with the weight it deserves after you understand everything that comes before it. So let me start with something that happened to a woman I am going to call Carol. Carol had done everything right. Decades of careful saving, no debt, no financial drama. She woke up on a Tuesday morning, checked her phone, and the number she had been watching grow for 3 years was just gone. Not partially, not a suspicious charge, gone. And the bank representative she called that morning explained what had happened using language that was technically accurate and practically incomprehensible. And then they told her it was all in the agreement she had signed. I want you to hold that image. We are coming back to it. But first, I need to rewind, because what happened to Carol did not start on that Tuesday morning. It started the day she opened her account, just like yours did. Here is what most people believe a bank account is. You deposit money. The bank holds it. You can take it back whenever you want. Simple, safe, yours. That mental model is not wrong exactly, but it is incomplete in ways that only matter under specific conditions, and those conditions tend to arrive at the worst possible moments. When you opened your bank account, you signed an agreement, not the pamphlet, not the summary card they handed you at the branch, the full document, the one that runs anywhere from 18 to 40 pages depending on the institution, the one with section headers like "notwithstanding the foregoing" and "subject to applicable law," the one that most people scroll past in under 4 seconds before clicking accept. That document is a permission structure, not a service contract, and understanding the difference between those two things is the entire point of this video. A service contract says, "Here is what we will do for you." A permission structure says, "Here is what we are allowed to do." Those are not the same sentence, and most depositors have spent their entire banking lives operating under the first interpretation, while the second one has been quietly sitting in the background, waiting. Now, the $20,000 number. Why does this video keep coming back to it? It is not a legal threshold. It does not appear in any federal statute governing your savings account. It is not the number the government uses to trigger financial reporting, though a related but separate law does cover large cash transactions. $20,000 matters because of what it represents inside a bank's internal profitability model. A depositor holding $20,000 in a savings account, collecting interest, carrying no loans, no mortgage, no credit card balance at that same institution, represents what banks internally classify as a deposit-only relationship. In the language of retail banking, that is the least profitable category of customer a bank can hold. You are giving them money to manage. They are paying you interest to keep it there, but you are not borrowing from them. You are not generating the loan revenue that makes your relationship worth maintaining on their terms. And the account agreement you signed contains the specific tools the bank needs to manage that relationship when it decides the terms need adjusting. There are 4 clauses. Let me walk you through them one at a time. If you owe money to the same bank where you hold your savings, on a credit card, a personal loan, a car note, anything, the bank holds the documented legal right to reach directly into your deposit account and take funds to cover that debt. Without calling you first, without a court order, without starting a collections process. The transaction happens and then you get a notification. The standard agreement language reads something like this. We may, without prior notice, apply funds from any account you maintain with us to satisfy any obligation you owe to us, whether or not that obligation is currently due. Read that last part again. Whether or not that obligation is currently due. That is not just about missed payments. That applies to balances that are not yet late. A credit card balance with 2 weeks until the due date can be offset against your savings today if the bank decides it wants to exercise that right. And if you are in a dispute with the bank over a charge, the offset is not paused while the investigation runs. It can happen in the middle of it. I dismissed this clause for years as a background legal formality. What changed my mind was a conversation with someone who had spent nearly a decade working in escalated customer service at a major retail bank. Her job was explaining to customers why their balance was not what they expected. She described the volume of those calls without drama, the way you describe a predictable feature of your work week. There was a script for it, because the calls came that regularly. Federal law sets minimum standards for how quickly banks must make deposited money available to you, but account agreements routinely extend those hold periods under specific conditions, and one of those conditions is a deposit that pushes your total balance past an internally defined threshold. When a large check or transfer arrives into an account already holding around $20,000, the bank's agreement may give it the right to hold a portion of that incoming deposit for up to 10 business days, 2 full calendar weeks. During that window, the funds appear in your balance. They show up on your statement. They are legally yours. You simply cannot move them. And the hold period starts the day of deposit, not the day you find out the hold exists. Most people who experience this describe it as a surprise, not because the bank hid it, because it lived in a document they signed years ago and never looked at again. Most account agreements give the bank the right to close your account at any time, for any reason, or for no stated reason at all, with or without advance notice. That part most people have at least heard of in passing. Here is the part they have not thought through. When a bank closes a deposit account, the standard return method for your funds is a mailed check, not a wire transfer, not an instant digital payment, a paper instrument sent to the address the bank has on file, which must then be deposited at another institution where it will be subject to that institution's own hold policy for up to another 10 business days before the full amount is available. $20,000 that is legally yours, confirmed on paper, and practically untouchable for anywhere from 3 to 15 business days at a moment you did not choose and did not plan for. In a calm environment, this provision sits quietly in the background. In a stressed environment, the exact kind of environment where you would need that money most urgently, clauses 1, 2, and 3 can operate simultaneously, layered on top of each other, each one within the terms of the agreement, each one producing a different reduction in your practical access to money you believed was immediately available. And now,
This is the one I have been holding back. And I want to be careful here, because this clause is not a secret. It was documented in Federal Reserve examination records for years before most people ever heard of it. Regulators knew it existed. It operated completely within what was then legally permitted. It is called deposit reclassification. Here is how it worked. Banks are required to hold reserves against certain categories of deposits, funds that must stay put rather than being deployed into loans and investments. The reserve requirement is a regulatory ceiling on how much of your deposit money can be used to generate bank revenue. So, overnight, while your account showed no activity and you had no interaction with your bank at all, institutions were quietly moving customer balances between internal accounting categories, not moving the money, moving the label, reclassifying which internal bucket your balance sat in for reserve calculation purposes. A change that reduced the bank's calculated reserve obligation without touching a single dollar in your account. And then, before the next business day opened, the reclassification was reversed. No trace in your account history, no entry you would ever see. The balance you checked in the morning matched the balance from the night before. But in the hours between, the bank had legally reduced its obligations using your savings as the mechanism. This ran on ordinary savings accounts at virtually every major American bank for years. What the 2008 financial crisis revealed was not that this mechanism existed. Regulators had known for a long time. What it revealed was the scale of the legal infrastructure quietly operating on ordinary deposits between the moments when customers thought about their money. Now I want to come back to Carol. What happened to Carol on that Tuesday morning was the right of offset. She had a savings account and a credit card at the same institution. She had never been late, she had never missed a payment, but she had crossed an internal threshold the bank had defined. And the bank, operating entirely within the terms of the agreement she had signed, made a decision about the relationship that she discovered only after it had already been made. The agreement is available right now on your bank's website, in the Disclosure section. Search for Account Terms and Conditions. Find the paragraph on right of offset or set-off. Find the paragraph on account termination and how funds are returned. Find the paragraph on hold periods for large incoming deposits. Read those 3 paragraphs, not for alarm, for accuracy. Because the mental model you are currently carrying about what your bank can and cannot do with your money is either confirmed or corrected by those paragraphs. And the only way to know which one is true for your account is to actually read them. The clause you have not read did not start mattering the day something went wrong. It started mattering the day you signed it. The only question that remains is whether you find it before the bank uses it or after.